Hello, everybody. Today I want to talk about something a bit different than we usually talk about. We usually talk about trade ideas and such. Today I want to touch on a bit of a different topic. Recently on YouTube, and it's been going on probably for a year or two now, where the passive investing um, flow on YouTube is getting larger and larger and larger. And now for a decade plus, people have been passive investing even more and more, but it's really sped up on the media and especially in YouTube over the last 2 or 3 years, I'd say, where you have the channels that are growing that advocate for passive investing, like Graham Stephan, like Ben Felix. These are channels that have lots of subscribers that are in favor of passive styles of investing. And I want to give my perspective on that, which is the opposite perspective of why active is better than passive, and sort of counter what everybody else is thinking out there and give another perspective to it. So first I just want to define everything, and then afterwards I actually want to get into why I like active, and then finally we're actually going to look over some back testing and everything, multiple back tests to actually see how everything did, active versus passive. But first I want to define what passive and active actually mean. So passive investing definition. So usually when you're passive investing, you're buying and holding a benchmark, like the S&P 500 for the long term, basically buying and holding an index fund for long periods of time. It's a set it and forget it mindset. You buy it and then you forget about it, and you just on a regular basis dollar cost average into it and you forget about it. And so you set it and forget about it, and that's the type of mindset that you use. It's a low engagement form, hence why it's called passive investing. You don't really engage with the money much. You just put the money in there and you keep it inside the index fund for long periods of time. So it's a low engagement form of investing. And the whole point is that the argument that tends to be made is that you can't usually beat the market, that only 3% of people long term will be able to beat the market. So you instead just want to match the market. And so that's usually the argument that's made by people who are in favor of passive investing. But I'm going to give my take on active, talk about the definition, because my definition of active is quite different from what other people consider active investing to be. Okay, active investing definition. Actively using strategic products and strategies to trade quantitatively backed opportunities. So it can have a fundamental or technical bias, but we usually like to have some sort of a statistical pot odds perspective on what's going on. And I oftentimes talk about pot odds. That's really what it is. The probabilities playing out over time. Trading small and trading often. Trading often, I'm going to get into why we like to do that with a back testing that talks about trading often. But we like to trade often for the most part because it gets a higher amount of occurrences going. If I just flipped a coin once, I might get heads, I might get tails. If I flipped a coin 5 times, I may get heads 5 times or tails 5 times. But to actually let it play out, I need to do it, say, 1,000 times, so I can actually get 500 heads, 500 tails. It plays out a lot better. That's why you like to trade often. You get a better number of uncorrelated occurrences, and then you trade small because if the first time doesn't go good, at least you're able to do it again and again and again, and roll positions again and again and again. And we also want to say we engage in liquid markets for actionable opportunities. Really, this one has to do more with the media, what's going on in the news. When you look at the media, 90% of what you see is not actionable. 90% of what you see is already past news. They might say Dow went down 200 points, Dow went up 200 points for fill in the blank reason. Great, but that's not actionable. That's just something that happened in the past. It's not going to tell me about what happened in the future. Build domain skill sets. So this is a big one right here. This is one of the big problems that I have with passive investing. People are oftentimes in favor of passive investing because it's passive. They say that you don't need to learn anything, that you just need to log into a brokerage platform, type in a ticker symbol like SPY, type in a quantity, and then just click confirm and send, and you're done. The problem with that is that you are not building any domain skill sets in the process. Just with a few $1,000s, if you're a very active trader, you can trade. A fairly good active trader is going to make 10,000 trades a year. Very, very active traders can make far more than that. Well, in making every single trade, you're making lots and lots of decisions, and over time, the decisions become unconscious. So I might make 100 different decisions, most of which are unconscious before making a trade. And if I make 10,000 trades a year, I'm making a million extra decisions. My decision making skills get better, and other areas of making skill sets ultimately gets better. Because people who passively invest for years and years and years, they're just really being a robot at the end of the day. They're not creating skills. When you actively invest, you create domain skill sets, because if I make a million extra decisions a year and I'm a young person, let's say a young person, meaning an adolescent to a young adult, we can define that as someone who's somewhere between a teenager and someone in their early 20s. If they just took a few $1,000s and they were able to make a million extra decisions every single year, it would impact them not just in their trading, but everywhere else in their life. So it helps you make decisions, and it ultimately builds domain skill sets. And going along with this next point of being product indifferent and building domain skill sets, we can actually combine the two for this one right here, where people will oftentimes say things like, futures are very risky. And oftentimes I hear passive investors say this. And then on the other side, they'll say something along the lines of, index funds are very safe. What they miss, though, is that I can buy an S&P 500 index fund, and I can buy 500 shares of SPY, and I get the same amount of exposure as buying one E-mini S&P contract. Or I can buy 50 shares of SPY, and I get the same amount of exposure as buying one E-mini micro future on the S&Ps. So they say futures are risky, and they say index funds are safe, but really at the end of the day, many of these options and futures and derivative products are just exactly that. They're derivatives of those same products. If I buy 50 shares of SPY, it's the same thing as me buying a micro S&P future. So they're the same exact thing. And that ties in with being product indifferent and building domain skill sets. The reason people lose money on futures is not because of futures themselves. It's because they don't know how to properly use them. It's like driving a car, for example. If you sent, for example, a 5-year-old to go drive a car, they would get in a car accident. You sent someone who could actually drive that car because they have a car license, they're going to do perfectly fine, and it's a good vehicle. It's a good vehicle if used properly and if there are proper domain skill sets. The problem in the finance industry is that people using products like futures do not have proper domain skill sets. And that's a major thing that we try to bring to the table right here, is because if I buy, people need to understand it's all the same thing. If I buy that S&P future, it's the same thing as me buying 50 shares of SPY, or me buying a bit of a larger future, like the minis versus the micros. I buy a mini, that's the same thing as me buying 500 shares of SPY. And if I go a step further and I buy one of the big contracts, it would just be bigger than that. But it's all the same thing at the end of the day. They're all just derivatives of each other. They have a one-to-one correlation. They're 100% correlated. Yet they say futures are risky and they say index funds are safe. But they're the same exact product. Problem is, people do not understand how to trade futures, even though futures, from a capital perspective, are 15 times more capital efficient. Buying that micro future costs 15 times less than buying 50 shares of SPY. But people will buy 50 shares of SPY because they consider it to be safer, because they don't have the domain skill sets yet that are used in trading futures, even though at the end of the day, they are 100% the same product. And that's what we mean by building domain skill sets and being product indifferent, is that a lot of these products are just the same exact thing. They're derivative products of each other. They have a 100% correlation. Same thing with many option strategies, like bullish risk reversals on something like SPY is the same thing as buying SPY, which is the same thing as going out and buying S&P futures. Yet they have different risk levels, and usually people will consider the options to be a medium risk level, the futures to be a very high risk level, and the index fund to be very conservative. But at the end of the day, they are 100% the same thing. So you need to learn to be product indifferent in that way and just go wherever the capital efficiency is. And the futures markets have more liquidity because of SPUs, what we call the S&P 500 futures. They are more liquid than the index fund. And on top of that, they're one-to-one correlated. Everything is baked in. Risk-free rates are baked in. Dividends are baked in. Everything is already baked inside the futures price. It is a perfect price. The thing is, it's just a one-to-one correlation. It's just the same thing. Yet it's 15 times more capital efficient, and there's a lot more liquidity right there too. So, and also on top of that, you guys have less rules attached to it, like pattern day trader and such. So being product indifferent is something else right there too. And being product indifferent can also be me selling a put on IBM versus selling a put on gold. I need to treat every product the same way. Now, it doesn't mean my viewpoint on every product is going to be the same, but it means I treat it all the same way. I don't treat a equity in a different way than I would a commodity. I try to treat them from a secular perspective, from a perspective where I am neutral on everything, where I look at everything. And this doesn't mean you can't be bullish on gold and bearish on IBM or the other way around. It just means you have to look at it from a objective perspective, and you need to treat every vehicle like it is the same exact thing. And of course, there's a bit of a rosy definition of active investing, because when most people think of active investing, they think of usually Warren Buffett style stock picking or timing the markets. But notice how everything I've talked about right here, none of it has to do with any of that. Yes, it can be that if you want it to, but it doesn't need to be. Active investing can be done by people who have no idea what's going to happen in the markets. And people usually get into three categories. Category number one is, I know what's going to happen in the markets, and so I'm going to trade based off of that. This is where you'd put your Warren Buffett type stock pickers who are going to pick the things that outperform. This is where you put your George Soros type macro hedge fund guys who are going to be able to pick the best sectors and be able to do a sector rotation. They will be able to pick the best currencies. This is where you put those people. They will also be able to do things like time the market. That's where you put that. The vast majority of people go in the second group. The second group of people say something along the lines of, I either think you cannot predict where the markets will go because they are very efficient, or I think it's very hard to predict where the markets will go, and I don't think I am able to predict where the markets will go, so then I will go ahead and invest in an index fund because that is the only option I have. The third group of people are based off of that second group of people. The third group of people say something along the lines of, I don't invest in an index fund and I actively invest, yet I don't know what will happen in the markets, also I don't stock pick, I don't pick sectors, I have zero directional bias. So I'm trying to show people that they can move from that second group into that third group. You can actively invest and not have any idea what's going to happen with market direction. The two do not need to be connected. You do not need to say active investing equals predicting where the market will go or trying to stock pick or anything along those lines. It doesn't have to. It can if you want it to, but it does not have to. Those two things are not connected. And so that's a big one right there. That's a big one because people always passively invest because they say, I cannot predict where the markets will go. And they look at passive investing or index funds as the answer. But I don't think passive investing or index funds are the answer. Active investing does not need to 100% mean I'm timing the markets, or I'm stock picking, or I'm picking sectors and doing sector rotation. It doesn't need to mean any of that, right? Active investing can be done in a way where it has zero directional bias. And that's where we're actually going to be talking about with our backtest, where we are not going to be doing anything like market timing, not going to be stock picking, not going to be picking sectors, not going to be picking currency outperformances or commodity outperformances, none of that. We're going to be doing it from a purely similar to an index fund where you just dollar cost average into it. We're just going to be doing it systematically again and again and again. And that's what people really need to take away. Because the largest crowd, 99% of passive investors say, I can't beat the market because I can't predict it, I can't stock pick, I can't do any of these other things. Let me just invest in an index fund. But hey, who said that active investing has to equal being able to do any of those things? Okay, so I already really got into this on the last slide, but why active is better than passive? First off, you build know-how. Again, I talked about this one quite a bit, where with passive investing, you really gain zero skill sets. When you actively invest, you start to learn about everything. You learn about spot Forex, you learn about Forex futures, you learn about commodity futures, you learn about how everything is regulated. You really actually immerse yourself in it and you learn something and you have an interesting discussion about finance at the end of the day. And you can't do that with passive investing. With passive investing, you are robotic. You just go ahead and you invest in it. Active is not the same though. It has a lot more engagement too. Again, going along with the first thing, active investors don't try to avoid what is going on in the markets. Passive investors will oftentimes try to hide what's going on in the markets. So they'll invest in an index fund and the markets go down 50% and they try to ignore that fact. And they just try to invest more in the index funds and dollar cost average in, but they try to separate themselves in the market and they try not to look at what's going on in the markets on a day-to-day basis. I feel like it's a mechanism that you use when you're losing money. People oftentimes will put their money in a certain stock, the stock goes down, they try not to look at that stock instead of actually facing the problem up front, which is that they lost money, and trying to find a solution to it. And I sort of feel like passive investing goes down that route, where the problem is that you might have just bought in a very overvalued market, and then the market drops 50%. Well, instead of facing it head on and actually trying to find a solution, what passive investors will do is they'll say, oh, the market's eventually going to come up. Let me just dollar cost average in. And I never thought that that was a good way of going about things. It's personally just facing it up front and looking at the markets is a better way to go about things rather than the passive style, because the passive style, you try to ignore everything that's going on in the markets. You try to put yourself in a position where you're ignoring everything that goes on in the market so you don't emotionally go and sell out of an index fund after it's down 50%. My answer to that would be, because many people say the reason I invest in index fund is because I just do a dollar cost average in. I would oftentimes ask them, well, what do you do when it goes down 50%? They say, oh, I try to hide myself from it and I try to ignore that it's down 50%. And I'll just go ahead and I'll just dollar cost average in. And I'll actually try to ignore that it's down 50%. But the problem is that it's down 50%. You don't just ignore the problem to try to solve it. And so I just never understood that style right there, because the active investor would say, well, I don't let my portfolio get down 50% or 80% or 90% in the first place. And so engagement is a big thing, and actually solving that problem up front, where oftentimes RIAs or financial advisors will tell you, oh, eventually the market's going to come up, and that's going to be, they're going to act as if that is a solution to a market that is down 50%, where you just lost 50% of your wealth. And so that's a major thing for me right there, is that active investors who do active investing properly will not even let that happen to themselves. Reduce sequencing risk. This goes along with what I just said right now. And a passive investor might make 7% a year, but one year they're going to make 30%, the next year they're going to lose 60%, right? It goes back and forth. There's a lot of sequencing risk of returns. It's not 7%, 7%, 7%. It is 30%, negative 50%, 30%, 30%, 30%, negative 60%, right? It's back and forth, back and forth, back and forth. It is sequencing risk that you tend to have right there. Lower standard deviation. So this really just means less volatility at the end of the day. Higher returns. We'll actually be going over that in our backtesting. Makes higher returns due to market cyclicality. So while passive investors have to face market cyclicality and the market's going up and down a lot by dollar cost averaging in after markets have gone down a lot, active investors, on the other hand, can actually take advantage of that and make money on the way down and make money on the way up once again, which is very different from passive investors, where their solution to a market that is down is just a dollar cost average in, so their average price that they got in is lower. But it's still a loser at the end of the day when you dollar cost average in. And so making higher returns due to market cyclicality is generally a good thing right there too, because markets are cyclical and you can actually make money off of that. Because oftentimes you'll have a stock that's at $100, goes to $105, goes down 95, then goes right back to $100, does that all within 3 months. Well, the passive investor bought in the index at 100, and that's 103 months later, they didn't really make anything. People who trade around that, they're able to make higher returns due to market cyclicality, as we like to call it, or oscillation back and forth in the markets, where the market might be at $100 today, 3 months from now it's at $100, but it goes from 100 to 105 to 95 back to 100, and it oscillates, or it goes through a cyclical cycle, and you can take advantage of that. is backed by probabilities. Most passive investors will just say that they buy into the markets and they do that because long term it's going to go up. Really, not too many probabilities behind that though. Active is more so backed by probabilities. It can also be made delta neutral. This means that you don't have a directional bias. You can trade in a way where, regardless of the markets going up or down, you don't have a directional bias. Returns in sideways markets. This is due to making money from the passage of time. Implied leverage. So implied leverage meaning that if I buy a call option, I have a lot of leverage over the stock price. But even if I sell that call option might expire a year from now. And so I do not need to face the obligation till a year from now. Yet I collect the premium upfront right now. And so that's another thing right there, is that you have this implied leverage both from the seller and buyer's perspective. You also have a reduction in cost basis. This is something that I'm going to talk about on the next slide. If you do something like covered calls, you might buy a stock and sell a call option. What you're doing when you do that is you're limiting your upside. Many people don't like to limit their upsides because they're worried that the market will run away from them, that it'll just go higher and higher and higher. But when you sell a call option again and again and again, if I buy 100 shares of stock for $10,000 and I sell call options on it for $2,000, what I'm really doing is I'm reducing my cost basis. If you just bought the 100 shares, your cost basis is $10,000. You bought the 100 shares, sold a call option, it's $8,000. Call option expires, sell another call option, now it's $6,000. Sell another call option, $4,000. Sell another call option, $2,000. Sell another call option, your cost basis is completely gone and you own the shares for free. And that's what it means when we say reduction in cost basis. You're able to sell something against what you own, and because of that, you have a reduction in cost basis. It creates more liquid markets. This one basically, it's fairly obvious. When you're active, you have a lot more traders, a lot more transactors, a lot more participants in the market, and so it creates a lot of tight and deep liquidity in the market, whereas passive investing gets rid of that liquidity completely. All active investors need is a contraction of volatility, and this is where the statistical part of it comes in. All active investors need is a contraction of volatility, which is guaranteed mathematically and happens 88% of the time within 45 days from the backtesting. Passive investors need the market to go to all-time highs, so you might be looking at 7% return every single year. Well, eventually the market's going to have to go to all-time highs, which has lower probabilities, lower returns, and then also higher downside risk. You consistently have that downside risk, whereas active investors are able to make money even if the market is dropping and it's going lower and lower and lower. And so active investors, really all they need is that contraction of volatility, and that is mathematically guaranteed. It is mathematically proven that implied volatility tends to mean revert. And because implied volatility mean reverts, and it happens 88% of the time within 45 days, that's when I'm talking probabilities, that's when I'm talking statistics. They have a statistical advantage that passive investors do not. Okay, right here, I told you I'd talk about this right here. Since June of '86, covered calls versus the index itself, and a couple of other ones. So you have covered calls, S&P, and then put. And so covered calls delta 30, so 30 days to expiration delta 30. It has outperformed. And then S&P 500 is the second one, and the third one is the put rate. Look at how the ones where you're actually adding onto your cost basis, like the one right here, you actually barely made any money. The one where you reduce your cost basis, like the covered calls, you outperform the S&P 500, and then the put rate outperformed the S&P 500 until very recently, but now I'd say that this actually has reversed and has started out outperforming, and this is just purely from a return perspective. But we haven't even looked, though, yet at the risk, and if you look at this, you'll notice that the covered calls dropped a lot less during '08, the puts dropped a lot less, and the index dropped quite a lot. And so that's another thing right there, is that you'll lose less money on the way down, but on the way up, look at that. Covered calls outperformed even during the largest bull market in history. Puts were very close to outperform. You can see the S&P was all the way down here. Puts were still up here. And so they were close to outperforming, but they didn't quite outperform. The one thing that I'd say about the put rate index is it only goes out 30 days. So if you actually look 45 days out at the money and you manage winners, the put rate a put rate strategy would have outperformed massively on the market. short cash secured puts backtest. So here's the backtest I said we'd be looking at. And then afterwards, I actually have another backtest from Taster Trades, a quick one about implied volatility and realized volatility and where the opportunity really is. But I want to take a look at this backtest first. And by the way, all of this is linked in the description below, and it's linked in the comment section below, pinned in the comment section and linked in the description below. So if you guys want to actually look at this backtest on your own, you guys definitely can. So I looked at some backtesting of short cash secured puts to look at some less directional trades versus the S&P 500 from 2007 to 2019, 45 days to expiration. The specific backtest I would look at would be the one standard deviation, delta 16 managed at 25% of max profit. So less directional, it's still slightly directional, but one standard deviation or delta 16 is a specific one that I'd be looking at. One standard deviation delta 16 has a 16% directional bias on the S&P, whereas when you just buy an S&P index fund, you have a 100% directional bias. So it has a lot less of a directional bias than just buying an S&P fund would. And so that's definitely something to look at. It has less of an effect and less of a drawdown when the market comes down. Okay, so return on capital is the first one right here. So SPY, short puts, 45 days to expiration, leveraged, CAGR, that would be compound annual growth rate right there. Okay, so looking at this right here, it is leveraged, but this is leverage, but even with leverage, if we actually look at the volatility, it has less risk. So you always want to look at the leverage relative to volatility. So if you have a lot of volatility, you would like to use less leverage, and that's why the SPY is completely unlevered, but the put selling is slightly levered. This is not full like portfolio margin or span margin is 6x leverage. It's not even 2x leverage. It's a very small amount of leverage, and it actually eats down after I looked at the specifics with the backtesting. It actually eats down a lot on the returns because when you do this sort of thing, you were in a situation where you're gonna have to pay a lot every single year on the Reg T margin interest, and that actually eats away a lot on the amount that you're making. But now we're in a situation where brokerages are actually charging less than what I looked at for what this website was doing with their backtesting. And it's still less exposure than the SPY. The SPY, you buy it, you get 100% exposure, a delta 100 exposure. With the 16 delta puts, even if it's 1.5 times levered, you're still getting 24 delta exposure. So it's a lot less directional, and so it's actually a lot less levered from that directional delta perspective. And of course, as you can see right here, managed at 25%, basically made the same exact return, even though a lot less directional risk right here. Okay, percent of profits spent on commissions. I'm going to say that commissions should be ignored because now we have commission-free trading, and we have many brokerages like Tastyworks that charge you to open a trade, but they don't charge you to close a trade. And so it brings in this new dynamic where commissions really should be ignored, and commissions are going to eat up a large percentage of, or would have decades ago, eaten up a large percentage of your profits, but nowadays they don't. And so if we look again right here, 10%. And so if we can actually raise this return by 10%, it'd be up here. And on top of that, let's not forget about the amount you'd be paying for margin interest, which now many brokerages are bringing that all the way down. And I looked at what this website was including for margin on the puts that you were selling on leverage, and it was very, very high. After taking all that into account, this right here should actually be somewhat closer to 10% than the SPY is, down at about 7.5. So, with that said, I do think that we're in a situation where the one standard deviation is already outperforming, managed at 25% of max profit. Okay, consistency. So this is another one right here. Sequencing risk is what we're talking about. What is the consistency? What percentage will you, um, what percentage of your trades will win? And so this is a win rate looking purely not at probability of success, but probability landing in the money, which is actually smaller than probability of success. So this should be even higher. And right now it's basically 90%. It should be even higher, closer to 100%. So you essentially win every single trade. Down days, right here, a lot less down days. Somewhere around 700 down days. Right here, well over 1,000 down days. Risk relative to reward. So this is a Sharpe ratio. It's essentially going to measure how much volatility you have in your portfolio versus how much reward you have, or how much of a return you tend to have. Looking right here, one standard deviation, we see that the Sharpe ratio is far better, managed at 25% than SPY is, and most of these strategies tend to have a better Sharpe ratio. And in fact, we can also see that the blue or red bars, which are ones where you actually trade often, you try to get rid of the profits as quick as possible and roll over to the next expiration, they tend to make more than where you are holding till expiration 75% of max profits. And this is including things like commission and margin costs and spreads and everything else. If it wasn't, that would be even higher from what I've seen. Max drawdown, right here, you've essentially got a 20% max drawdown. If you're using the 16 delta or one standard deviation, SPY, well over a 50% drawdown. And this was during the 08 crash. And so you would have done a lot better during the crash on the way down. And on the way up, though, I still think you would have made a very good amount. And remember, this is with the leverage. And this is why I was saying I'd much rather sell one standard deviation puts with leverage than buy the SPY with no leverage, because even with that leverage, you're only down 20%. Volatility. Again, even with the leverage, your volatility is less than 10%. Volatility on SPY is closer to about 15%. And this was actually during a relatively low volatility period. And so you can imagine that even though you're using leverage, you're putting yourself in a position where the volatility is a lot less, the Sharpe ratio is a lot higher, max drawdowns are a lot smaller, so I'd actually rather use leverage on far out of the money put selling than just buying the index fund with no leverage. Okay, so this is the one from Tasty Trade that I wanted to take a look at. Shorter time frames have more opportunity. So something that we oftentimes hear is that buy and hold is the best way to go. And I simply disagree with that style of investing or trading. And this is why my definition of active investing is very different. It's trade small, trade often. And so this is very different from what others are showing. And I would say that right here we have finally found, because before I had many reasons, but I did not have a concrete statistical backtest. Well, Tasty Trade released this, and it was actually released a few years back. I didn't find it until recently, and so I wanted to actually bring it up because this actually proves what we've been talking about for a long time about trade small, trade often, and that being the best way to go about active investing and investing in general, because active is the best style of investing. And what this says right here is taking a look at implied versus actual implied, or actual versus implied volatility. And what we see is that the main thing you need to take a look at is percent difference overstated and actual number outside expected. So percent difference overstated. 1 month to expiration, options tend to overstate their implied volatility by 41.5%, whereas 1 year to expiration is only 20%. So when we're using one of these strategies, what we notice is that the implied volatility works in our favor a lot better shorter to expiration. Looking at the other one, actual number outside expected, only 15% of the time will the realized volatility or the actual volatility go outside the implied volatility. Whereas on the other hand, 1 year to expiration, it's going to happen a third of the time. And this right here really shows you why implied volatility works in your favor when selling options closer to expiration. Now, the person who's owning an index fund as a passive investor is likely going to say, well, here's the thing though. What does that have to do with me? I understand if you're trading options, volatility affects option prices, but what does that have to do with me? Volatility does not affect the price of an index fund. True, but it doesn't directly affect it. The big but is that volatility tends to have a 80% negative causation to the price of the S&P 500. So if you look at the S&P 500 volatility, 80% of the time it will go higher as the index goes lower. So if implied volatility overstates realized volatility by a lot, and realized volatility is really, really small and is a lot lower, then 80% of the time the index will be a lot higher. But right here, what we're seeing is that 1 year or further out in expiration, implied volatility doesn't actually overstate itself that much. That it's actually realized volatility relative to implied is actually quite high 1 year to expiration. And if we actually went down longer term, 4, 5, 6 years, we'd see that it's actually quite high. And so the realized matches the implied very far out. So even further out than 1 year, it matches the implied further out. And so you have it matching the implied volatility further out. And so realized volatility is higher. If realized volatility is higher with the 80% negative causation, the index should be lower, and thus your returns as an index fund investor are lower. And so implied volatility tends to work best 45 days to expiration. Of course, if volatility is in backwardation, you go shorter to expiration. If volatility is in contango, you go further out to expiration. You obviously can make adjustments to this, but this is a real statistical probabilistic backtest right here. Looking at that, the amount that it overstates the implied volatility risk premium, as we like to call it, that's really there on a short-term time frame, and you don't find that on a long-term time frame. And that's also why over here at Alpha Action, when we usually use options, whenever we buy an option, we always, not always, but 95% of the time, we'll try to sell something against it. So earlier I was doing a QQQ front spread trade. Well, in the front spread, you don't just straight up buy a call or a call vertical. You buy a call vertical by selling a call and then using the premium collected to finance the buying of the call vertical. And so I oftentimes, whenever I buy options, I almost always buy an option and sell an option against the option that I bought. And I do that because implied volatility tends to overstate a vast majority of the time. I would say right here about 85% of the time. 1 month to expiration is even more, I think 45 days to expiration. But it really tends to overstate. We can actually look 3 months to expiration, and yeah, I can say, yeah, it really overstates. So we try to find where the opportunity is on the shorter term time frames, and the max opportunity is on the shorter term time frames. And that's what needs to be understood. That's why we sell options, or if we buy an option and we're making a directional bet, I want it to fly in my direction very, very quickly. If not 95% of the time, what I'm going to be looking for it to happen is that I'm going to be looking for it to slowly go in my direction. So I'll buy a longer dated option, something like a calendar or a calendarized vertical spread, and buy a vertical and sell a vertical against it, or also turning into a calendarized butterfly spread. And I will always sell something against what I buy so I can reduce cost basis, because implied tends to overstate realized, especially in shorter term time frames. But that brings about opportunity for us. And this is opportunity that people who are investing for the quote-unquote long term do not have. Okay, conclusions from the study. So this is a study that was done, the one about the put selling. So 1 standard deviation put selling outperformed the S&P 500. 1 standard deviation put selling had less volatility. 1 standard deviation put selling had smaller drawdowns. Trading more often was more profitable. This study was done when we had historically low volatility along with the longest and strongest bull market in history. So even though we had the strongest bull market in history, where if you buy SPY, you were getting delta 100 exposure to the underlying asset, versus if you sell the put, where even with say 1.5 times leverage, you're only getting delta 24 exposure to the underlying. So really, we gave index funds the benefit of the doubt, and along with that, we had historically low volatility. So when selling the puts, you really didn't collect a lot of premium like you normally would have in a higher volatility market environment. Under normal circumstances, the index would severely underperform the one standard deviation short put, with winners managed at 25% of max profit. This is a rules-based systematic style of trading. So this really goes back to the big theme that I've been making for passive investors, which is that passive investors tend to come out and they tend to say something along the lines of, I cannot predict where the markets go, so I'm going to invest in an index fund. Well, guess what? You don't have to invest in an index fund just because you don't know where the markets are going to go. Active trading and active investing does not equal predicting markets, timing markets, sector rotation, stock picking, whatever you want right there in the fill in the blank right there. Active investing does not need to equal that. And so this is a rules-based systematic style of investing. You have a couple of rules right there: manage profits at 25%, sell puts one standard deviation, these different rules, and you just systematically do it again and again and again. It does not require you to time the market. It doesn't require you to do all these other things that are going to be required of you from what people think of active investing. And so people think of active investing as timing the markets, but it's absolutely not that. It can be if you wanted to, but it does not necessarily have to be that. Shorter time frames has the most implied volatility risk premium. I talked about this with the last study that we just looked at. That's where the highest opportunity is. When you have high implied volatility risk premium, that is where you go. That is where the opportunity is. And reduction in one's cost basis causes higher probability of success. This goes along with the covered calls. So with the covered call, even though I'm limiting my upside by selling that call option, what I'm really doing is I'm having higher probability of success. Whenever you just sell a call option without owning the shares, that's a naked call, a naked short call, as we would call it. And over there, you're going to put yourself in a position where you have infinite risk, but you have limited profit potential. Well, if you have infinite risk and you have limited profit potential when selling that call option, you have to get compensated in some way. And the way that you get compensated is with higher probability of success. The probability of you then making money is like 95% versus you just going out and buying the call option where you have infinite upside but very small limited downside, but your probabilities are going to be very low. You can combine that with a covered call, which is just going to be a combination of buying stock and selling a call, and you tend to have very high probabilities. So even though you limit your upside, you reduce cost basis, and it creates higher probabilities of success, and eventually you own the underlying asset for absolutely free. Okay, so what we could have done to make higher returns. So basically, ignoring the commissions, ignoring the margin costs, because nowadays brokers are taking commissions, they're down to zero, spreads are tighter, you're in a situation where margin costs, the percent paid for margin costs are getting closer to zero. So the return was really closer to 10% for a one standard deviation put. We could sell calls against it and turn it into a strangle, essentially making 20%. We can also readjust strikes or re-neutralize deltas, giving us higher probabilities. Again, this goes along with managing winners. Instead of just keeping it there until expiration, you actually move it around a lot and adjust strikes, re-neutralize deltas. And this is going to raise your returns even further. So now instead of 20%, you can make an even higher percent of return. Take volatility term structure into account. This is whether volatility is in contango or backwardation. And take implied volatility rank into account. After taking all those things into account, you are very likely to make a 50% return. And looking at all of that, you can create a simple, rules-based, systematic style of investing or trading, whatever you really want to call this at the end of the day. Create a rules-based, systematic style of trading. If we're going to stick with the word trading, because I think that's what most people are going to refer to this as, where you simply go out and you say, okay, I'm going to look for 20 different stocks or futures or currency pairs, whatever it may be, that have high implied volatility rank above 70, and then I'm going to look at their volatility term structure. Then I'm just going to sell a one standard deviation strangle, and I'm going to go and use position sizing based off of the volatility of the underlying, and based off of that, if it's more volatile, use smaller position sizing, and pick a bunch of different underlyings, go do that on, manage winners at 25% max profit. For losers, I just readjust strikes, and then eventually after it expires, I roll it over to the next expiration period, and I give my losers some duration to work themselves out. and that's a simple systematic rules-based style of trading where you have just a couple of rules, the amount of rules you can count on your fingers, and based off of those rules, you're going to make 50% a year. So again, active does not need to mean timing the market. And that is a big, big thing I want you to take away, because passive investors tend to look at this, they tend to say, I can't time the markets, so I'm going to passively invest. I'm telling them there's a better way, and you still don't need to time the markets. Simple rules, the amount of rules you can count on your fingers, those are the amount of rules that you're going to need for a simple rules-based systematic style of trading. You just look at it, you say, great, it's got high IV rank, volatility, term structures, and backwardation. I'll go off 3 weeks, sell one standard deviation strangle, manage winners at 25% of max profit, adjust strikes to re-neutralize deltas, no more than 2 standard deviation of directional risk, and go along and consistently roll my losers. Perfect. That's all you need. And that's just a baseline right there for 50% returns. Add more rules onto it, add some directional bias if you want with technical or fundamental analysis, and you can make over 100% a year. But that is really the base of what you want to do right there. Okay, so where to find out more? This channel, of course. We're always here on this channel answering questions, and if your question doesn't get answered, YouTube tends to have this thing with their algorithm where we can't see all the comments that are put down, where it oftentimes says 4 comments, which happened on my last video where it said 4 comments, but then I looked down at the comments, there are only 2 comments. So I wasn't able to see all the comments, and I didn't get notified about the comments. So if that happens, just email us, therealalphaaction@gmail.com. Tasty Trade is linked in the description below, and also pinned in the comment sections below. The research study used, same thing. And the CME's website, where you can find out a lot more information about all this stuff, linked in the description below and linked in the pinned in the comment section below. Other than that, happy trading, everybody. Happy investing. And if you guys have any questions, again, just ask us. Any comments, ask us. If you guys still are a fan of passive investing, I would really like to find out why. And we'll have a little friendly debate in the comment section. Other than that, thank you for watching, everybody. Happy investing.